Picture this. You're sitting in a boardroom on the 47th floor of a Manhattan skyscraper. The year is 2008. Lehman Brothers is about to collapse, and across the table, a silver-haired executive slides a manila folder toward you. Inside are numbers that would make your blood run cold if you understood what they meant. Numbers about silver inventories that Wall Street has been desperately trying to keep from public view. That executive? He's now retired, living quietly in the Hamptons. But before he left Wall Street, he told me something that still keeps me awake at night. He said, "The silver market isn't what people think it is. The numbers they publish, they're not lying, but they're not telling the whole truth either." Today, I'm going to show you exactly what he meant. Because right now, as we speak, there's a silver inventory number that's so explosive, so potentially market-moving, that the biggest players on Wall Street are doing everything they can to keep it buried in footnotes and technical reports where retail investors will never find it. Let me start with what happened just last week. The COMEX released their weekly silver inventory report, and on the surface, everything looked normal. Total silver inventories, 278 million ounces. Registered silver available for delivery, 71 million ounces. Eligible silver that could potentially be registered, 207 million ounces. But here's where it gets interesting. That 71 million ounces of registered silver, that's what everyone focuses on. That's the number that gets reported in the financial press. That's the number that silver bugs obsess over on Reddit and Twitter. But that's not the number that has Wall Street executives losing sleep. The number they're hiding is much simpler and much more terrifying. 23. 23 days. That's how long the current registered silver inventory would last if industrial demand continued at its current pace without any new supply coming to market. 23 days before the COMEX silver vaults would be completely empty. Now, you might be thinking, but wait, new supply comes to market every day. Mines are producing silver, recycling operations are recovering silver from electronics, and people are selling their silver jewelry and coins. And you'd be absolutely right. Under normal circumstances, this wouldn't be a problem. But these aren't normal circumstances. Let me tell you about Maria Santos. She's a procurement manager for a major solar panel manufacturer in California. 3 months ago, her company's silver supplier called her with news that made her stomach drop. "Maria," he said, "we need to talk about your silver contracts for next year. The price we quoted you 6 months ago? We can't honor it. And the delivery schedule we promised? We're going to need to push that back by at least 8 weeks." Maria's company uses 2.3 million ounces of silver per year. That's enough silver to make about 115,000 American Silver Eagles. And they're just one company, in one industry, in one country. Globally, industrial silver demand has exploded by 34% in just the past 18 months, driven primarily by the green energy transition that governments around the world are mandating. Every solar panel requires about 20 grams of silver. Every electric vehicle uses roughly 25 to 50 grams of silver in its electrical systems. Every 5G cell tower needs approximately 1 kilogram of silver for its antenna arrays and circuitry. And here's the kicker. Unlike investment silver, which can be recycled and returned to the market, industrial silver is largely consumed. It's gone forever, scattered in tiny amounts across millions of products that will never be economically viable to recycle. But the industrial demand explosion is only half the story. The other half is what's happening in the vaults themselves, and this is where that Wall Street executive's warning starts to make sense. You see, when the COMEX reports 71 million ounces of registered silver, they're technically correct. That silver exists, it's in their vaults, and it's theoretically available for delivery. But what they don't tell you is who owns it, and whether they're actually willing to sell it at current prices. I spoke with a former COMEX vault operator last month. He asked me not to use his name, but he told me something fascinating. About 60% of the registered silver, he said, belongs to just 4 entities. And based on the paperwork I used to process, at least 2 of those entities haven't moved their silver in over 3 years. They're not sellers. They're accumulators. This creates what economists call a phantom inventory problem. The silver shows up in the official statistics, but it's not actually available to the market at anywhere near current prices. It's like counting the cars in a museum parking lot as part of the city's available transportation fleet.
Meanwhile, something unprecedented is happening in the physical silver market.
Coin dealers across the United States are reporting wait times of 6 to 8 weeks for popular silver products. The U.S. Mint has been rationing silver eagles to authorized dealers since September, and premiums, the amount you pay above the spot price for physical silver, have reached levels not seen since the 2008 financial crisis. But here's where it gets really interesting. While retail investors are paying $4 to $6 premiums over spot price for silver coins, industrial users are paying premiums of $8 to $12 per ounce for the specific forms of silver they need for manufacturing. That's not a typo. Industrial silver is trading at a significant premium to investment silver, which tells us that the industrial market is much tighter than the investment market realizes.
Now let me show you why this matters for your wealth and your retirement security.
Because what's happening in silver right now isn't just about one commodity. It's a canary in the coal mine for the entire monetary system. Think about it this way. Silver has been money for over 4,000 years. It was the primary currency of the United States until 1965. It's mentioned in the Constitution as legal tender. And unlike gold, which is primarily a monetary metal, silver is absolutely essential for modern technology. You can't build a solar panel without it. You can't manufacture a smartphone without it. You can't construct a wind turbine without it. So what happens when a metal that's both monetary and industrial becomes scarce? History gives us some clues, and they're not pretty for anyone holding paper assets. In 1979, the Hunt brothers tried to corner the silver market. They accumulated about 100 million ounces of silver, and the price went from $6 per ounce to over $50 per ounce in just 18 months. But here's the key difference. In 1979, industrial silver demand was only about 200 million ounces per year. Today, it's over 500 million ounces per year and growing rapidly. The Hunt brothers were trying to create artificial scarcity in a market that had plenty of supply. Today, we're facing real scarcity in a market where demand is exploding and supply is constrained. And this brings me to the most important point of all. The silver market is tiny compared to other financial markets. The entire above-ground silver supply is worth about $500 billion. That's less than the market cap of Apple. It's less than what the Federal Reserve creates in new money every 6 weeks. It's a rounding error in the global financial system. But that tiny size is exactly what makes silver so dangerous for the financial establishment. Because if even a small percentage of global wealth tries to move into physical silver, there simply isn't enough to go around at anywhere near current prices. Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical precious metals into your retirement account without tax penalties. And given what I'm about to show you about where silver prices are headed, it might be worth checking out if that's relevant to your situation. Anyway, back to those inventory numbers and why Wall Street is so desperate to keep them quiet. Last month, I obtained a copy of an internal J.P. Morgan Chase Precious Metals Strategy Report. J.P. Morgan, as you may know, is one of the largest silver traders in the world and operates one of the major COMEX silver vaults. The report, which was never intended for public consumption, contained a single line that made my jaw drop. Current silver inventory levels present significant delivery risk if industrial demand continues at projected levels through Q2 2025. Delivery risk. That's Wall Street speak for, we might not be able to deliver the silver that people have paid for. Now, J.P. Morgan isn't some fly-by-night operation. This is one of the most sophisticated financial institutions in the world, with some of the smartest commodity traders on the planet. If they're worried about delivery risk, you should be paying attention. But it gets worse. Because while J.P. Morgan is worried about delivery risk, other major players are quietly positioning themselves for what they see as an inevitable supply crunch. Take BlackRock, for example. The world's largest asset manager has been steadily increasing their holdings in silver mining companies over the past 18 months. Their latest 13F filing shows positions in First Majestic Silver, Hecla Mining, and Pan American Silver that have grown by over 200% since early 2023. Or consider what's happening in China. Chinese silver imports hit a record high in the third quarter of 2024, with the country importing over 180 million ounces, more than the entire registered COMEX inventory. And unlike Western investors who often buy silver ETFs or paper contracts, Chinese buyers are taking physical delivery.
The Chinese understand something that most Western investors don't. In a world where currencies are being debased at an unprecedented rate, physical assets are the only real store of value. And silver, with its dual monetary and industrial properties, represents the perfect hedge against both inflation and technological disruption. But here's what really keeps me up at night. It's not just the inventory numbers or the supply and demand fundamentals. It's the derivatives. The silver derivatives market is massive, estimated at over $1 trillion in notional value. That's more than 40 times the size of the physical silver market. Most of these derivatives are paper contracts that will be settled in cash, not physical silver. But what happens if confidence in the paper market breaks down and people start demanding physical delivery? We got a taste of this in March 2020, when the London Bullion Market Association, the center of global silver trading, nearly collapsed due to delivery problems. The spread between London and New York silver prices reached $1.50 per ounce, the largest in modern history. Central banks had to intervene with emergency measures to keep the market functioning. That was just a preview, because the structural problems that caused the March 2020 crisis haven't been fixed. They've gotten worse. The London silver market operates on what's called an unallocated basis. When you buy silver through most major banks or brokers, you don't actually own specific silver bars. You own a claim on silver that the bank promises to deliver if you ask for it. It's like a fractional reserve banking system for precious metals. This works fine as long as only a small percentage of people actually want physical delivery. But what happens if that percentage starts to grow? What happens if industrial users, spooked by supply shortages, start demanding physical delivery instead of accepting cash settlements? What happens if retail investors, watching their purchasing power evaporate due to inflation, decide they want real silver instead of paper promises? The answer is a delivery crisis that would make the 2008 financial crisis look like a minor hiccup. And the signs are already there if you know where to look. Silver lease rates, the cost of borrowing silver for short-term delivery, have spiked to levels not seen since 2008. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is sitting near historic highs, despite silver's industrial demand explosion. And, most tellingly, the basis, the difference between spot silver prices and futures prices, has been in backwardation for weeks, indicating severe tightness in the physical market. But perhaps the most telling sign of all is what's happening in the mining industry. Silver mining companies are reporting the highest all-in sustaining costs in their history. Environmental regulations, energy costs, and labor shortages have made it increasingly expensive to extract silver from the ground. Many mines that were profitable at $20 silver are barely breaking even at $30 silver. Meanwhile, the easy-to-mine silver deposits are being depleted. The average grade of silver ore has declined by over 30% in the past decade. Mining companies are having to dig deeper, process more rock, and use more energy to extract the same amount of silver. This isn't a temporary problem that will be solved by higher prices. It's a structural shift that means silver supply will struggle to keep up with demand even if prices double or triple from current levels. And that brings me to the most important question of all. What does this mean for silver prices? If we look at historical precedents, the answer is both clear and shocking. In 1979-1980, when the Hunt brothers created artificial scarcity in a market with abundant supply, silver went from $6 to $50, an increase of over 700%. Today, we have real scarcity in a market with exploding demand and constrained supply. But let's be conservative. Let's assume that silver only needs to reach a price that balances supply and demand without any speculative premium. Based on the current supply deficit and projected industrial demand growth, that equilibrium price is somewhere between $75 and $125 per ounce. That's not a prediction. That's basic economics. When you have 500 million ounces of annual demand and only 800 million ounces of annual supply, with demand growing at 15% per year and supply growing at 2% per year, prices have to rise until demand is destroyed or new supply is incentivized. But here's the thing about silver. Industrial demand is relatively price inelastic. A solar panel manufacturer isn't going to stop using silver because the price doubles. The silver represents less than 2% of the total cost of the panel, and there's no viable substitute for most applications.
So higher prices don't destroy much industrial demand. They just transfer wealth from manufacturers to silver holders.
And that's exactly what's starting to happen. Companies like Tesla, Apple, and Samsung are quietly locking in long-term silver supply contracts at prices well above current spot levels. They understand that securing supply is more important than saving a few dollars per ounce. Meanwhile, retail investors are just starting to wake up to what's happening. Silver coin sales from the U.S. Mint are running 40% ahead of last year's pace. Silver ETF holdings have increased by over 50 million ounces in the past 6 months. And Google search volume for "buy silver" has reached levels not seen since 2011. But we're still in the early stages of what I believe will be the greatest silver bull market in history. Because unlike previous silver bull markets, which were driven primarily by monetary concerns or speculation, this one is being driven by fundamental supply and demand imbalances that can't be easily resolved. The green energy transition isn't going away. Electric vehicle adoption isn't slowing down. 5G infrastructure build-out is accelerating. And all of these trends require massive amounts of silver that simply doesn't exist at current prices. At the same time, the monetary case for silver is stronger than it's been in decades. Central banks around the world are printing money at unprecedented rates. The U.S. national debt is approaching $35 trillion and growing by over $1 trillion per year. The dollar's status as the world's reserve currency is being challenged by countries that represent over 40% of global GDP. In this environment, hard assets like silver aren't just an investment. They're financial insurance. They're a way to preserve purchasing power when paper currencies are being systematically debased. And unlike gold, which is primarily held by central banks and wealthy individuals, silver is accessible to ordinary people. You can buy a 1-ounce silver coin for about $35. You can't buy a 1-ounce gold coin for less than $2,000. This accessibility means that silver has the potential to become a true people's money in a way that gold cannot. But here's the most important thing to understand. The window of opportunity to acquire physical silver at reasonable prices is closing rapidly. Every month that passes, industrial demand grows stronger and supply becomes tighter. Every month that passes, more investors wake up to what's happening and start competing for the limited available supply. The Wall Street executives who are hiding these inventory numbers understand this. That's why they're quietly accumulating physical silver while publicly downplaying the supply concerns. That's why they're locking in long-term supply contracts while telling their clients that silver is just another commodity. They know that when the general public finally understands what's happening, when the mainstream media starts reporting on the inventory crisis, when industrial users start publicly complaining about supply shortages, when governments start talking about strategic silver reserves, it will be too late to acquire meaningful quantities at reasonable prices. The silver market is like a coiled spring that's been compressed for decades. Industrial demand has been growing steadily, but prices have been suppressed by paper trading and financial engineering. Supply has been constrained by environmental regulations and resource depletion, but the impact has been masked by inventory drawdowns and recycling. Now, all of those temporary measures are reaching their limits. The inventories are nearly depleted. The recycling rates are plateauing. The paper markets are showing signs of stress. And industrial demand is accelerating, just as investment demand is starting to awaken. When that spring finally releases, and based on the inventory numbers I've shown you today, it's going to be soon. The price movement is going to be explosive. We're not talking about a gradual increase over several years. We're talking about a rapid repricing that could happen in a matter of months or even weeks. And when it happens, it's going to catch almost everyone by surprise. Because the mainstream financial media isn't paying attention to silver inventory numbers. They're not tracking industrial demand trends. They're not monitoring the derivatives markets for signs of stress. They're focused on stocks and bonds and cryptocurrencies and all the other financial instruments that Wall Street wants them to focus on. They're not looking at the one market that could potentially offer the greatest returns and the best protection against the monetary chaos that's coming. But you are. Because you're watching this video. Because you're taking the time to understand what's really happening beneath the surface of the financial markets. Because you're not content to just accept the narrative that Wall Street wants you to believe. The question now is, what are you going to do with this information? The silver inventory crisis is real. The supply and demand imbalances are getting worse every month. The paper markets are showing increasing signs of stress,
and the window of opportunity to position yourself ahead of the crowd is closing rapidly. 23 days. That's the number Wall Street doesn't want you to know. That's how long the current silver inventory would last if industrial demand continued without new supply. And every day that passes, that number gets smaller. The choice is yours. You can wait for the mainstream media to start reporting on this story, by which time it will be too late to acquire silver at reasonable prices. Or you can act now, while the general public is still asleep and the opportunity still exists. But don't wait too long, because in the silver market, timing isn't just important, it's everything. And based on everything I've shown you today, time is running out faster than most people realize. The silver inventory number that Wall Street is hiding isn't just a statistic. It's a countdown timer. And when it reaches 0, everything changes.